Hello, everyone, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today we are going to be having a very interesting session where we look at what's currently happening in the markets. Of course, there have been quite a number of developments over the week, and this is currently influencing major markets, and of course, creating quite a number of opportunities for traders. So we'll be looking at the major highlights for the week. And once we go through the major highlights, then we look at what we'll be expecting for the rest of the week. And that's Friday. And we all know what's happening tomorrow. We will be focusing on the US non-farm payrolls. And this has the potential to cause some good volatility in the markets. And of course, create an opportunity for you to squeeze in some pips. So once you join in, kindly say hi on the live comment section. And these will confirm that everything is working just fine. All right, so let's start with the economic calendar. We're trying to share this page right now. So since the beginning of the week, we have had quite a number of data points. I think among the most important ones on Monday was manufacturing PMIs for China, Eurozone, and the UK, as well as the US. So key highlight was that there was a slight improvement in China, but still data remained within contraction territory for manufacturing. And for the rest of the countries that they were reporting, ranging from Japan, Australia, the Eurozone, UK, all of them had contractions and a slight improvement in the US. So then we had the interest rate decision by the Reserve Bank of Australia, which disappointed the markets. Everyone was expecting that the Reserve Bank of Australia would go for a 25 basis point hike, but instead they chose to hold interest rates level at 4.1%. And as a result of this, we have seen a widespread weakness in the Australian dollar. So going forward for the rest of the week, I expect to see the Australian dollar continuing to lose against stronger currencies. So later on, we had the JOLTS job openings. This is basically the number of job advertisements in the US in the last 1 month. So in the previous reading, it was 9.62 million. We expected this to slow to 9.61, but the drop was much bigger to 9.58, meaning that there are less employers advertising for jobs. And this is quite consistent with what the Fed is looking to achieve. ISM manufacturing PMI came in at 46.4, which was lower than expected, but slightly higher than the previous reading. So this is also consistent with what the Fed is looking to achieve. And as a result of these, we have been seeing quite a number of reactions in the markets. Then fast forward, we go to Wednesday. We see the unemployment rate in New Zealand rising to 3.6%, whereas the employment change quarter over quarter was up 1.0%. The surprising data point was the ADP non-farm payrolls. In this case, we saw a record number of jobs created in the last 1 month, which came in at 324K jobs compared to 191K. Remember the previous reading, it was also more than double. So the ADP has been having some diversion or divergence from the official data. Then CPI for Switzerland came in at negative 0.1%. And of course, the annual inflation dropped to 1.6%. And this is quite nice for the SNB, that is the Swiss National Bank. So for them, they have won the battle against inflation. So in this case, they might shift their focus to economic growth as well as reaching full employment for the economy. Then later on, we had the interest rate decision where 8 members of the Monetary Policy Committee in the UK decided to vote for a 25 basis point rate hike. So in this case, interest rates were moved to 5.25%. And we saw some volatility happening with the UK pound earlier in the day. Then we had unemployment claims coming from the US, which basically read 227K compared to the previous reading of 221, meaning that there's more people claiming for unemployment insurance, which basically implies that the job market is softening, which is also consistent with the Fed's expectations. Then there's ISM services, which came in slower than expected at 52.7, yet another data point that is showing consistency with the Fed expectations. So Going on towards the last day of the week, we will be expecting to see at 4:30 a.m. the RBA monetary policy statement. This is basically in follow-up of the decision that was made earlier in the week. So this will be a pretty important data point, which will give more direction on where the Reserve Bank of Australia is looking to see interest rates headed, or basically the entire monetary policy for Australia. So this will be very important for AUD traders. So while the AUD has been weakening, there is a chance that if there is a change in the tone of the monetary policy statement, then it could reverse the trading of the Australian dollar. But then if it affirms the same policy where they held interest rates level, then we could be seeing some shifts happening around here. So then later on in the day, we'll be looking at data coming from UK. This will be construction PMI. And then in the Eurozone, we'll be looking at the retail sales, which are expected to have grown at 0.3% in July. We look at economic forecast for the Eurozone, and then a speech from MPC member Peel at 2:15 p.m. The most important data point for tomorrow will be the unemployment rate for the US, the non-farm employment change, or what we call the non-farm payrolls, and of course, the average hourly earnings. So the Fed is focused on this data point, mainly because it has a direct impact on inflation. So they want to see job market conditions softening. So by softening, they want to see the unemployment rate rising. The number of new jobs created in July, they expect to see a lower number. So while the previous reading was 209,000 jobs, they expect a smaller number, maybe 205 or even lower. So if there's a big spike in employment change, let's say something higher than a 205K, then it would mean that the job market conditions are not softening, which means that the Fed may have to implement another rate hike in September. So that would be pretty much bullish for the dollar. But then if this is weakening and comes in lower than this, then it basically means that we'll be seeing a much weaker dollar. So average hourly earnings, or what we basically describe as wage growth, it was growing at 0.4% in the month of June. So we expect this number to slow down in July to around 0.3%. So if there is a much faster slowdown, maybe 0.2 or 0.1%, then that would be consistent with what the Fed is looking to achieve. But then if it's higher than 0.3%, then that will be inconsistent. And as a result of that, we could be seeing the Fed considering another rate hike. So as I mentioned, from the last reading or from the last meeting by the Fed, they basically shifted to a data-dependent approach. So every time there's a new data coming up in the markets, then it basically shifts the probability of whether the Fed will go for another rate hike or not. So there's a very important tool that we normally use to estimate the decision that the Fed will make. So while new data comes up, then we see that data being reflected in Fed futures market. So the CME FedWatch tool basically shows the probabilities of either the Fed hiking interest rates or holding them level. So the next meeting is in 48 days from now. And from what we are seeing here is a decreased probability that the Fed may go for another rate hike. So this decreased probability is happening as a result of new data that is coming up in the markets. And as we have seen from the economic calendar, most of the data is consistent with what the Fed is looking to achieve. So if this data is consistent, then the probability of the Fed going for a rate hike gets smaller and smaller. So just last week, it was at 22%, and now it's 17.5%, meaning that there is a higher likelihood of 82.5% that the Fed will hold interest rates level at between 5.25% and 5.50%. So it's very important that we follow this through, because it has a direct impact on how the markets react. So right now, as we speak, we know that the most important news influencing the markets is the Fed, is the Fitch credit rating company downgrading US debt from AAA to AA+. And as a result of that, I think the biggest impact has been felt in US equity indices. So US equity indices had a big sell-off yesterday, and also today in the morning continued moving down. But then we go to a critical support level and the market changed direction. So you can see the US Tech 100 finding some very nice support from this area. So I remember doing this early in the morning during the market snapshot series. So from H1 chart, if you zoom out, you'll notice this area was acting as resistance, and now it has provided the necessary support for the market to reverse here. So you can see the market bouncing off strongly and getting back up. Same case is happening with the US 30. So after a very sharp drop, you can see the reversal happening. The market basically erasing all the losses it had made early in the morning. And then for the S&P 500, we were expecting some further drop towards 4,457. This did not happen. You can see the market made quite an impressive recovery. And right now, I think we have erased all the losses we had early in the morning. So as we speak right now, the fact that US debt has been downgraded in terms of rating, it basically adds more pressure to continue selling these equity indices. So even though we are seeing a nice bounce here, I expect long-term these prices to continue moving back downwards. So while we may have a nice bounce, it doesn't mean that the trend has changed. There's a good chance or a high likelihood that the market will continue selling. So the key driver after the market has rebounded from this strong bearish momentum will be tomorrow's announcement of the non-farm payrolls. So as I've said, we know that the non-farm payrolls are a key data point that the Fed is focusing on. So if the job market remains hot, that is unemployment rate is going down, number of jobs created in the month of July are higher than expected, and wage growth is strong, then in that case, the Fed may consider another rate hike. That would be very positive for the dollar. But then if we see the other way around, the job market softening, then that will be quite negative for the dollar. So we know that high interest rates are not very desirable right now, and they are making things worse. So if the Fed is forced to hike interest rates higher, then that would be negative for equity indices. But then if the Fed is forced to hold interest rates, then that would be positive for equities. So as for UK oil, we had a big sell-off happening yesterday, but then today we have had a complete reversal, and the market has erased all the losses we had experienced yesterday. And this was after an announcement by Russia as well as Saudi Arabia that they are going to continue cutting oil output. So with cutting oil output, it basically adds more bullish pressure on oil prices. So despite oil prices dropping to around $82.1 per barrel, we have seen oil prices resume a high price of $85. And if this momentum continues, then the target remains the previous high, which was yesterday in the morning around $85.8 per barrel. So as for the French 40 index, we have seen the big sell-off happening over the week. So from Monday, we saw a big sell-off on Tuesday, Wednesday, and then today on Thursday. But now after hitting this bottom, you can see the market is attempting to make some form of recovery. So if you didn't enjoy or benefit from this momentum, then it's time to wait for tomorrow's price action as a result of the NFP. So the EU 50 drops to our target of around 4,275. And once it got to this point, bounced off strongly. So you can see after getting around this area, bouncing off strongly, and now it's retesting a previous low right here. So we may not have as much momentum going forward. I believe most of the momentum will be coming from the announcement of the jobs data tomorrow. So for now, it's a wait and see kind of a scenario. I expect the markets to be moving sideways up until we get to the data announcement. So BTC is making some good recovery here after the big sell-off yesterday. So you can see the rejection candlesticks on the lower side, indicating that there is buyers entering the markets. So this is what I'm talking about happening here and also here. So we might be seeing some form of recovery happening as maybe we test the previous highs that we saw yesterday. So as for major currency pairs, if you look at USD CAD, you can see the dollar weakening against the Canadian dollar. And these only started after the big rally in the dollar started losing momentum. So the dollar has been pretty strong over the week, but today seems like the first day we might be seeing a negative close. That is the market closing lower than the open. So if this happens to be the case for the day, then all these currency pairs are expected to be making some form of recovery. So after the UK announced 25 basis point hike to interest rates, you can see there was a strong rejection on the 1 hour candlestick. And then on the 4 hour candlesticks, this is what we have, a very strong pin bar here, followed by a very strong bullish candlestick, indicating that this trend may have reversed. And now the original idea of a very strong pound USD now becomes more potent. So there is a good chance we'll be seeing the pound USD continue to rally through into next week. And a target of 1.28692 seems quite plausible. So with the dollar index being this weak, I also expect the Euro USD to be making a comeback. So in this case, we could be seeing the Euro USD make a push towards the previous high. And of course, the previous high is just nearby. It's a high that we saw yesterday, 1.10193. So we could be seeing the Euro making a rally towards this area, especially considering that the dollar index is starting to show some form of weakness. So the wild card in the markets right now remains the USD JPY currency pair, where the Bank of Japan is openly buying bonds. And by openly buying bonds 2 times in a week, basically means that there's a good likelihood that the Japanese yen will continue to weaken. So while the dollar was pretty strong and gaining against the Japanese yen, today has been quite the opposite. We have seen the Japanese yen gaining against the dollar as the dollar weakened this afternoon. But already you can see in the last 3 hours, the dollar is regaining momentum again. So the best way to trade this, and I have mentioned this before, is to look for a stronger currency and trade it against a weaker one. So in this case, my thesis remains pound yen. Pound and the Bank of England announced this morning they're going for 25 basis points, this afternoon. And then after the announcement, we had a whipsaw, and then eventually the market has clearly taken a direction. So from the last 2 hours price action, it's a pretty strong momentum. And now the idea is to go for a bullish trade, targeting the previous highs. And the immediate previous high for pound yen seems to be today's high, and last week's high, around 183.163. So there is a good chance we'll be seeing some further momentum happening here, and the pound running all the way back to 183.163 as the Japanese yen continues weakening. So you may also look at other pairs such as the CHF against the Japanese yen, as well as the euro against the Japanese yen. I believe those 3 pairs might have the best chances compared to the USD JPY currency pair. So New Zealand USD is also attempting to form some form of comeback here against the dollar. And of course, the one with the biggest sell-off was clearly the Audi USD as a result of the Reserve Bank of Australia holding rates steady. So you can see 3 straight days the market was selling, and now today it's attempting to make a comeback against the dollar. So if you're bullish on these, then 0.66000 seems like a nice target. In this case, betting on the recovery of the Australian dollar against the US dollar. So as we proceed, I'll be checking on the questions to see if there's any questions coming from the presentation. Oh, awesome. I got some good responses here. So hi, Apollo, Ali, Kevin. I can see franchise. I don't know how you pronounce that name. I can see James, Rebecca, and Levin. Molombe, welcome back. Hi, Richie. What's happening to the market? Just consolidating, save for JPY. Bank of Japan action makes trading JPY an extreme sport. Yes, but I think it's clearly unidirectional for Japanese yen. The currency has just been weakening, and that has been the story of the year. So in this case, I believe we'll be seeing some more weakness in Japanese yen. We just have to find the right pair, and of course, the right setup for your market entry. Pound CHF, I think those are 2 extremely strong currencies right now. I think the Swiss franc is very strong and the pound is very strong. So I would be more inclined to trade the pound against a weaker currency, and of course the Swiss franc against a weaker currency. So rather than trading pound CHF, I would go for pound yen and CHF yen, or pound AUD versus CHF AUD. USD JPY, I think I've already covered that. I mentioned that USD JPY is pretty strong, but it's even better to trade again the Japanese yen weakness against stronger currency. So yes, the dollar is strong, but already from the dollar index, you can see what has been happening for the day. It's the dollar weakening against other currencies. So while it's on one side, it's strengthening against the Japanese yen. I don't think it's the best option to go for if you're trading that weakness of the yen. Maybe the pound will be a much fairer bet. So yes, there is this rejection happening here. There's a nice pin bar indicating some bullish momentum. So of course, the target now becomes the immediate recent high. So this is the upside, but I think there's a stronger upside in pound yen pair. So in this case, the expectation is we see some further upside happening here towards this area for USD JPY. That's 143.536. So we have already covered gold. We have covered AUD/USD. So there's one more request. Japanese stock market, the Nikkei. And the Nikkei is basically benefiting from all this. So I believe we'll be seeing some further upside. While the currency continues weakening, the Nikkei is expected to survive from this. I'm trying to find it. Yeah, I found it. So while on one side, we have been seeing the Japanese yen weakening. In this case, I expect the Nikkei to be making some form of recovery. So this is what we are seeing. It seems like a slide to me. I don't know if it seems the same for everyone else. So after having a pretty nice better part of the year, which was pretty strong for the Nikkei index, what we are seeing here is the market consolidating for a while. And this is for a couple of weeks. I would say 7 or 8 weeks where we are seeing this form of consolidation happening. So now if I zoom, which we are looking at the 4-hour chart, this is the previous bottom here. And the market is already showing signs of reversal. So we could be seeing the Nikkei make an impressive comeback against the dollar. So for this area here, after the big sell-off that lasted at least 3 days, you can see the market is already attempting to mount a comeback. So I would be pretty bullish on this one, while I'm bearish on the Japanese yen. So thank you, Franchise. You mentioned that Fitch report is the primary mover for the current volatility, but I've watched several economists dismiss it. Or do you expect NFP to? Do you expect the NFP to neutralize Fitch? No, I don't expect that. I think the big gains that we have seen for SP 500, the Nasdaq, the Dow, already investors have been looking for signs of weakness in the markets to make an exit. And now that there is that Fitch downgrade, the last time it happened, it was from S&P Global. So when it downgraded the US debt, the immediate result was a big sell-off in the US equity indices. The dollar strengthened as well as other safe haven assets such as gold. And investors are already expecting something similar to be happening in the markets. So if this is what happens in the markets, then in this case, we will be expecting to see a continuation of the sell-off in equity indices. But then the dollar, I think for the dollar is pegged on what the Fed does. There's no bigger factor for any currency rather than their local central bank. So in this case, if the central bank of the US decides that this is the right move, then I think that's what will be affecting the markets. So the NFP will have a big impact on the Fed decision in September. So expect a reaction with a view on how the NFP report will be affecting the Fed decision. So for Fitch, if they're downgrading US debt, what they're basically saying is that at some point, there's a higher likelihood that the returns that are being given by US bonds will be carrying some form of risk. Maybe the US may have to devalue the dollar in order to pay those debts. So remember, this debt is expected to hit $1.6 trillion at the end of the year. So if this is not just the debt repayment, this is interest on that debt, just the interest on the debt. So if this interest on the debt keeps on rising at the same rate, then the risk becomes significantly higher over the next 2-3 years. And that's why the Fitch rating was only downgraded for the longer term equity, longer term bonds. So in this case, I'll be expecting that investors will be dumping some of these bonds and seeking some safe haven status. So that process might drag along. It's not something that happens at an instant. So over the next couple of weeks, I expect to see this migration happening bit by bit. And my best bet is on a bullish momentum on gold, bullish momentum on European currencies such as the euro, the pound, and of course, some bullish momentum happening in Bitcoin. What do you think of US oil price? It's the same thing. There's literally no difference between Brent oil and US oil. Yes, there's usually a small difference of about $4, but then the overall momentum is the same. So once you cover the analysis on Brent oil, it basically reflects the same way on the US oil. I believe we've already covered Brent oil on this particular session today. So I'll be covering one last request. I think this was EuroCAD. It's not a chart that I have checked before. So I'm mainly focusing on the major pairs because they are most liquid and they don't involve too much work in analyzing. So from this one, I'll try and zoom out and try to understand what's happening in this market. So from this, I can already see a market that is basically trading on some huge swings. So from the most recent momentum here on the 1 hour chart, you can see a market that was basically moving along this path here. From the lower side, I think it was moving along some form of path here. Then it was unable to form lower lows for some reason. So we can see the market testing this bottom like 3 times, failing to break and then forming a higher high. This high is clearly higher than the previous one. But then after the break, there's some form of retest. Market goes back and retests the breaking point. This is the area. And then since then, we haven't had much of a volatility in this chart. So I would say these last 2 days for the entire pair has been just sideways momentum. Like the overall momentum from this point to this other point is just sideways. This market is not going up, it's not going down, it's just moving sideways. So from the analysis here, you can see that the best course of action is to be patient and track the 2 extreme prices. This is the highs here at the high of the day. And of course, the low of the day is around this area here. So this is the price you track here. So if the market happens to break one of those, then it may present a trading opportunity. But for now, it's a market that is simply ranging. So that's it for the day. Thank you very much, guys. Thank you for your time, your participation, and I hope to see you on the next one. What advice can you give a person trading a pro farm account with $100,000 on risk management? I would say if your maximum allowed drawdown is 10%, so that's the amount you're trading. You're not trading that huge account. The amount you're trading is your maximum allowable drawdown. So if your drawdown is 10%, so out of your $100,000, it's actually $10,000. So just treat that account as if you're trading $10,000 and then apply proper risk management. So another comment here, downgrading the debt will make investors require a premium cover, making yields go up for the bonds and in effect make DXY demand stronger. Is it true? No, I don't think so. I don't think so. Yes, yields will be skyrocketing, but overall institutions don't like risk. So whenever they see that there's a prevalent risk of default, nobody would want to hold on worthless 10-year bonds. So they know, yes, the government must pay. That is, the US government must pay its obligations. But if the only way it pays this debt is by printing even more debt, then they will be getting the full value of that debt, but then the value of each dollar will be way lower as a result of devaluation. So that's the risk that everyone is concerned about. So while it may not be immediate, I think bit by bit, you'll see more institutions dumping more bonds. And by dumping more bonds, they'll be shifting to other assets that they deem to be safer in the markets. So thank you very much, guys. And I hope to see you on the next session.